Hello, friends. Welcome to the YouTube channel Learn Finance and Accounts. In this channel, we'll be discussing about cost of capital through retained earnings. So, retained earnings are one of the source through which capital can be raised. In the previous videos, we had discussed about cost of capital from other three sources, which are debt, equity share capital, and preference share capital. Retained earnings are the fourth source of capital, and we will be discussing how we will calculate cost of capital of finance raised through retained earnings. So please watch the complete video, like, share, and subscribe to the channel so you can continue getting constant updates from us on the various topics of finance. So let us have a small recap of what we have learned about cost of capital. See, the cost of capital of a firm is the minimum rate of return expected by its investors. So who are investors in this case? Okay, we will be discussing who are the investors in the case of retained earnings. So you will get a surprise when you get to know about who are the owners of retained earnings. So the capital can be used by a firm from different sources, which are debt, equity share capital, preference share capital, and retained earnings. The first three we have discussed, and now we are going to discuss about RE. So before knowing about the cost of retained earnings, let us first recollect what we know about retained earnings. Retained earnings are also called RE. It is the amount of net income left over for the business after it has paid out dividends to its shareholders. So when a company starts its business operations, it is expected to earn some return. So the company also thinks that it will earn some return, and this return or the net profit that the company gets, that profit is distributed amongst the shareholders or the owners of the company. Sometimes the whole profit is not distributed, and some part of the profit is kept by the company for future requirements, and that part of the profit is known as retained earnings. So who are actual owners of this money? Who should be getting this money? Are debtors the owner of this money? No. They have already received the share in the shape of interest. Who are the debtors? Banks are the debtors, or money lenders are the debtors. And they have received their part in the form of interest. So, is the business organization the owner of this money? No. Business organization is not the owner of this money. They were supposed to divide this money amongst the shareholders. So the actual owners of this money is the equity shareholders, those people who own the share, who have purchased the shares of the company. As this amount actually belongs to the equity shareholders, the cost of retained earnings is calculated in the similar way as that of equity share capital. Remember that D1 divided by P0 plus G, that was the formula for cost of capital through equity share capital. So cost of RE is calculated in two ways. One is called book value approach. Here cost is same as cost of equity, that formula. And the second method is called market value approach. So in the market value approach, we do not calculate the e- cost of capital through retained earnings. Why? Because in the market, shares are traded and not retained earnings. Retained earnings are not traded in the market. Shares are traded. So RE is not a tradable security. So we cannot calculate the cost. So that's all in this video. Formula we have already discussed. In case of book value approach, it is same as cost of equity. Formula also you know from that video. You can see that video again, which is D1 divided by P0 plus G from book value approach, and from market value approach it is not calculated at all. So that's all in the video. So before we go to another topic, before we end this video and start another topic, I'll just remind you that you can support us through this QR code so that we can continue making such educational content. And please subscribe to the channel. So we will meet again with another video on another topic. So that's all in this video. Thank you.